Imagine losing over $100,000 in retirement and never even realizing it. Not because of bad investments, not because of overspending, but because of a quiet tax rule that might disappear without much attention. This isn't some dramatic headline. It's a real possibility that could reshape how retirees manage their money for decades. Right now, a new tax bill is making its way through Congress, and if it passes, it could have a major impact on how much retirees pay or save on their taxes. One of the key issues in this bill, the fate of the expanded standard deduction, a rule that has quietly saved retirees thousands of dollars each year since 2017. Back in 2017, the standard deduction was doubled. It made tax filing easier and for many, more affordable. But it came with an expiration date, December 31st, 2025. If nothing changes, that rule goes away and the old tax system comes back, one that relied more on personal exemptions. Now here's the problem. Those old exemptions don't offer as much tax protection for most retirees. That means if the standard deduction shrinks and the old system returns, taxes go up, even if your income stays the same. Let's break it down simply. You start with your total income for the year. Subtract certain deductions like contributions to IRAs or health savings accounts, and you get your adjusted gross income, or AGI. Then, from that number, you subtract either your itemized deductions or the standard deduction, whichever is higher. That standard deduction is like a tax-free buffer. You don't need forms, you don't need receipts, just a big chunk of income that isn't taxed at all. But if the rule expires, that buffer shrinks, and the amount of income that gets taxed goes up. Let's look at an example. A retired married couple, both over 65, can currently deduct around $33,200 from their income. If they earn $100,000, only $66,800 is taxable. But under the old rules, that deduction would drop by nearly $10,000. And that's just 1 year. Over a full retirement, that gap can grow even wider. With moderate inflation, the difference could reach $20,000 or more in tax-free income lost each year. Still wondering what that means in dollars? Let's take a closer look. Imagine the couple retiring at age 65 in 2025. They have $1 million saved in a traditional IRA, plus $300,000 in a brokerage account. They receive $5,000 per month in Social Security, and they use the standard deduction, not itemized deductions. In the first few years, they manage to avoid most federal income taxes, thanks to smart withdrawal strategies and partially tax-free Social Security benefits. But as time goes on, and their IRA withdrawals increase, so does their taxable income. If the current tax rules stay in place, they continue benefiting from that larger standard deduction. But if those rules expire, things change drastically. Within 10 years, they'll pay $32,000 more in federal taxes. And over 25 years, that number grows to $100,000. Extra taxes paid simply because of one rule change. This isn't just a technical issue happening in Washington. It's a real, measurable threat to retirees' financial health. It affects how you plan your IRA withdrawals, how much tax you'll pay on Social Security, and whether Roth conversions make sense for your situation. In short, this bill and the standard deduction it protects isn't something to ignore. It could be the difference between stretching your savings comfortably or struggling with unexpected tax bills in your 70s and 80s. That's why staying informed and flexible in your retirement planning is more important now than ever. Because your financial future might depend not on how much you earn, but on what Congress decides to take away.